Silver has been treated by institutions as a secondary market, important but manageable, liquid enough to absorb stress without drawing attention. That assumption is now being quietly tested, not by retail speculation or headlines, but by internal risk frameworks adjusting to conditions they didn't expect to see converging at once. At the institutional level, volatility isn't measured by price alone. It shows up first in behavior, order size changing, spreads widening at odd hours, hedges becoming more expensive before prices actually move. Recent commentary tied to JP Morgan doesn't frame silver as breaking, but it does acknowledge that the structure supporting day-to-day stability is under growing strain. And that admission changes how desks think about what comes next. Historically, when major banks flag volatility without assigning blame or narrative, it signals something unresolved beneath the surface. Not a crisis, not a forecast. Just friction accumulating, where smooth execution used to be routine. In silver, that friction appears less in outright shortages and more in timing mismatches, positioning asymmetries, and a market that reacts faster than models anticipate, hinting at a deeper imbalance. Behind closed doors, volatility is a cost problem before it's a price problem. It affects margin requirements, collateral efficiency, and the willingness to warehouse risk even briefly. When a firm like JP Morgan emphasizes volatility, it's not addressing investors. It's addressing internal tolerance, and that suggests the margin for error is narrowing in places most participants never see. What makes this moment different is how quietly the language has shifted. There's no alarm, no directive to exit, just an acknowledgement that silver is behaving less like a passive commodity and more like a contested financial instrument. That shift matters because once volatility is treated as structural rather than temporary, strategies change in ways that aren't immediately visible. Market behavior implies that some of the usual shock absorbers are losing effectiveness. Liquidity still exists, but it's less forgiving. Price discovery still functions, but it's more abrupt. When large institutions start planning around those conditions, they're not reacting to what's happened. They're positioning for what could happen if stress compounds. The unanswered question isn't whether volatility will increase or fade. It's whether the market can absorb it without forcing participants to retreat, rebalance, or reprice risk all at once. And that question sits at the center of how silver is being viewed right now, even if few are willing to say it openly. Behind closed doors, volatility in silver isn't being discussed as a headline risk, but as an operational one. The concern isn't dramatic price spikes. It's the growing difficulty of executing size without unintended consequences, where trades that once disappeared into the market now leave visible footprints. At the desk level, available data suggests that intraday moves are carrying more information than they used to. Small shifts are triggering outsized responses in derivatives, forcing adjustments that ripple across related markets. This kind of sensitivity doesn't appear suddenly. It builds when positioning becomes uneven and confidence in short-term stability starts to thin. Historically, JP Morgan has treated silver as a market where risk could be distributed efficiently across time and instruments. That assumption relies on predictable liquidity cycles and reliable counterparties. Recent commentary implies those cycles are becoming less synchronized, introducing gaps where risk lingers longer than models assume. What's notable is where the stress is showing up. Not in front-month contracts alone, but in the spaces between maturities, where hedges are meant to smooth exposure. When those transitions become less orderly, volatility stops being a temporary feature and starts behaving like a persistent condition. Market behavior also implies that some participants are adjusting defensively without fully exiting. Positions aren't being abandoned. They're being reshaped, shortened, or paired in ways that reduce exposure to sudden moves. That kind of repositioning can stabilize prices in the short term while quietly increasing fragility underneath. Institutional risk teams watch these shifts closely because they tend to precede more visible changes. When liquidity becomes selective rather than abundant, the market begins to reward speed and penalize size. That dynamic doesn't announce itself, but it alters who can operate comfortably and who can't. The tension lies in how long this state can persist without resolution. Volatility that's managed quietly can coexist with stable prices until something forces alignment. And the longer that alignment is delayed, the more abrupt it tends to be when it finally arrives. Historically, silver's volatility has been cyclical, flaring during macro shocks and fading as conditions normalized. What's drawing institutional attention now is that recent fluctuations don't trace cleanly to a single driver. They're emerging from overlapping pressures that don't unwind on the same timeline. From a risk perspective, JP Morgan's focus appears less on directional bets and more on correlation risk. Silver isn't moving in isolation. It's reacting to shifts in rates, currency expectations, and industrial demand signals that don't always reinforce each other. When correlations weaken or invert, hedging becomes less precise and volatility becomes harder to neutralize. Available data suggests that futures positioning has become more sensitive to marginal changes in sentiment. This doesn't mean leverage is extreme, but it does imply that conviction is thinner. In those conditions, markets can swing on relatively modest inputs, creating movement that feels disproportionate to the news driving it. What complicates matters further is the dual role silver plays. It functions as both a monetary metal and an industrial input, and those identities don't always align. When financial participants and industrial users respond to different signals, price action can fragment, increasing noise without providing clarity. Institutional desks tend to tolerate volatility when it's coherent, when it points in a clear direction or resolves quickly. The current pattern, by contrast, suggests volatility that stalls rather than resolves, forcing participants to manage exposure repeatedly instead of decisively. Market behavior implies that some traditional anchors are less reliable. Historical ranges still matter, but they're being tested more frequently. Each test that doesn't break reinforces uncertainty rather than confidence, subtly changing how risk is priced across the curve. The unresolved issue is whether these pressures will converge or continue to overlap. Convergence brings resolution, even if it's uncomfortable. Overlap prolongs uncertainty, and uncertainty is where volatility thrives the longest. At the institutional level, prolonged volatility forces a reassessment of assumptions that usually go unquestioned. Silver has long been modeled as a market where stress dissipates through depth and diversity of participation. Recent signals suggest that participation remains broad, but depth is becoming conditional. JP Morgan's framing points toward a market where liquidity hasn't vanished, but it's less willing. Orders are filled, but with more negotiation. Spreads normalize, then widen without warning. These are subtle shifts, yet they change the cost of holding exposure in ways that don't show up on price charts. Historically, when liquidity becomes selective, the market starts differentiating between time horizons. Short-term participants adapt quickly, adjusting or stepping aside. Longer-term holders face a different challenge: volatility that doesn't offer clear entry or exit points, only repeated tests of patience. Available data implies that some institutional flows are becoming more tactical. Positions are held for shorter durations, not because conviction has disappeared, but because uncertainty has increased. This shortens feedback loops and amplifies reaction speed, which can make even stable periods feel tense. What's unusual is how little of this is visible to casual observers. Prices may appear contained, even orderly. But beneath that surface, the effort required to keep them that way is rising. Markets can sustain that effort for a time, but it draws on capacity that isn't infinite. Institutional risk managers understand that volatility managed through constant adjustment is more fragile than volatility resolved through repricing. The former depends on coordination and confidence. The latter, while disruptive, resets expectations. The question hanging over silver now is which path it's on. Is the market absorbing stress through adaptability or merely deferring resolution through complexity? The answer hasn't revealed itself yet, but the conditions for it are quietly forming. Behind the scenes, one of the quieter concerns tied to rising volatility is inventory behavior. Silver inventories don't need to collapse to matter, they only need to move in ways that disrupt expectations. When availability becomes less predictable, even temporarily, pricing mechanisms adjust in anticipation rather than response. JP Morgan's attention to volatility suggests that these expectations are becoming harder to anchor, not because supply is disappearing, but because the timing of supply and demand is slipping out of alignment. In markets like silver, timing mismatches can generate more instability than outright shortages. Historically, when inventories stop acting as a buffer and start acting as a variable, participants become more cautious. They hedge earlier, roll positions differently, and demand more compensation for carrying risk. Each of those adjustments is rational on its own. Together, they raise the baseline level of volatility. Available data implies that some delivery-related signals are being watched more closely than usual, not as red flags, but as early indicators of stress. When these signals fluctuate without clear cause, they add to uncertainty rather than resolve it. What complicates this further is the global nature of silver flows. Production, refining, and consumption span jurisdictions with different economic pressures. Volatility in one region can propagate through the system unevenly, making local stability less reassuring than it appears. Market behavior implies that institutions are factoring in these cross-currents even if they're not acting on them aggressively. Risk isn't being pulled back wholesale, it's being compartmentalized. That approach works until compartments start interacting in unexpected ways. The unresolved tension is whether these timing issues remain manageable or begin reinforcing one another. If they do, volatility stops being episodic and starts shaping the market's baseline behavior, and that shift tends to surface faster than participants expect. Historically, when volatility becomes embedded rather than event-driven, institutions start questioning not just positions, but frameworks. Silver has benefited from models that assume mean reversion and orderly adjustment. Persistent instability strains those assumptions without immediately invalidating them. J.P. Morgan's emphasis appears to reflect that strain. Not a rejection of existing models, but a recognition that their confidence bands are widening. When outcomes spread out, risk limits tighten by default, even if no formal policy changes are announced. Available data suggests that volatility is also affecting how options are being priced. Premiums respond first, often before underlying prices move decisively. This shifts incentives, encouraging strategies that benefit from movement rather than direction and subtly reshaping market behavior. What emerges in these conditions is a market that feeds on anticipation. Participants react not only to what silver does, but to what others might do in response. That reflexivity can sustain volatility even in the absence of new information. Institutional desks tend to manage this by shortening horizons and increasing optionality. That reduces exposure to any single outcome, but it also increases turnover. Higher turnover doesn't guarantee instability, but it does raise sensitivity to sudden shifts in sentiment. Market behavior implies that confidence hasn't broken, but it's no longer assumed. Each session becomes a test rather than a continuation. That mindset changes how quickly risk is adjusted and how little tolerance there is for surprise. The underlying issue is whether this reflexive state stabilizes or escalates. If participants grow comfortable with it, volatility becomes normalized. If not, the market searches for a release valve, and those searches rarely stay contained. At the institutional level, the final pressure point in a volatile environment is coordination. Silver isn't dominated by a single narrative or participant, which usually makes it resilient. But resilience depends on shared expectations, and those appear to be thinning. J.P. Morgan's observations suggest that participants are interpreting the same signals differently. Some see volatility as opportunity, others as warning. When responses diverge, markets lose the rhythm that keeps movement contained within familiar bounds. Historically, this kind of divergence precedes moments where price action feels sudden rather than earned, not because information changes abruptly, but because alignment does. When enough participants act at once, often for different reasons, the market moves faster than explanation. Available data implies that this risk isn't concentrated in one segment. It spans futures, options, and physical linked instruments, increasing the chance that adjustments in one area transmit quickly to another. Cross-market feedback can amplify moves that would otherwise remain local. What's notable is how measured the institutional response remains. There's no rush to disengage, only a recognition that assumptions about stability can't be taken for granted. That restraint delays resolution, but it also preserves optionality. Market behavior implies that silver is approaching a threshold where outcomes depend less on fundamentals and more on structure. Structure determines how shocks are absorbed, who bears the cost, and how quickly equilibrium is restored. The unresolved question is whether that structure bends or resets. Both outcomes restore balance, but in very different ways, and the path chosen often reveals itself only after the fact. Historically, the most consequential shifts in markets don't announce themselves through price alone. They surface through subtle changes in language, risk posture, and tolerance. Silver appears to be in that phase now, where volatility is no longer treated as a temporary inconvenience, but as a condition to be managed. J.P. Morgan's emphasis reflects a broader institutional recalibration, not a forecast of disorder, but an acknowledgement that the margin between smooth functioning and disruption has narrowed. When that margin shrinks, Markets can appear stable right up until they aren't. Available data suggests that participants are increasingly aware of this fragility. Strategies are built with more exits, more flexibility, and less reliance on continuity. That adaptability reduces immediate risk while increasing sensitivity to shifts in confidence. What makes this moment unresolved is the absence of a forcing event. Without a catalyst, volatility can linger in a suspended state, shaping behavior without delivering clarity. That state is uncomfortable, but it's also revealing, exposing which assumptions still hold and which don't. Institutional markets often resolve these phases through repricing or reallocation. Either path restores coherence, but each carries different implications for participants who assumed stability as a given. The longer resolution is delayed, the more uneven its impact tends to be. Market behavior implies that silver is nearing such a decision point, even if timing remains uncertain. Volatility has done its work in surfacing tension. What it hasn't done yet is release it. The question now isn't whether the market recognizes the risk. It's whether recognition alone is enough to contain it, or whether containment gives way to something more definitive. For decades, silver has occupied a narrow space in institutional thinking. Important enough to monitor, stable enough to trust. That balance is now being re-examined, not because the market has failed, but because it's behaving in ways that demand more attention than before. What J.P. Morgan's commentary ultimately highlights isn't fear, but adjustment. Volatility is being treated less as noise and more as information. When institutions listen that closely, it signals that the old margins of comfort have thinned, even if the surface still looks calm. Historically, markets resolve these phases not through consensus, but through consequence. Assumptions are tested, strategies are filtered, and stability is redefined. Silver hasn't reached that moment yet, but the conditions that precede it are clearly present. Available data suggests that participants are prepared but not aligned. Preparation can delay disruption, but it can't eliminate it. Alignment only comes after a market decides what it's willing to tolerate and what it's not. What happens next doesn't hinge on a single report or price move. It hinges on structure, on how liquidity, risk, and expectation interact when pushed just a little further than planned. Those interactions are already shifting. In silver, volatility isn't the story, it's the signal. And signals like this tend to matter most just before the market stops whispering and starts deciding.